Today, we are wading into a subject that is, to be honest, one of the least glamorous, most overlooked corners of the tech world. We're talking about data storage, hard drives, system memory, the boring stuff.
Right. I mean, if you look at the last 5 years of tech headlines, it's all been about these revolutionary AI chips, quantum computing, these massive data centers. But the storage layer, the actual disks and flash chips that hold the data, that's just been background noise. It's supposed to be predictable, cheap, and, well, boring.
Exactly. You think tech rally, you think pure processing power. You don't think about the dull metal boxes sitting in a server rack or the little memory sticks you plug into a motherboard. And yet, here we are. Because the companies that make this plumbing are suddenly powering a massive, really shocking rally on Wall Street.
It's just the ultimate irony of this whole AI age, isn't it? It's like we built the engine of a Formula One car, but we completely forgot to check if the fuel tank was big enough, or, if the fuel line could even handle the flow.
Yeah, that's a great way to put it. Our source material today really digs into this sudden realization. We're working mainly from a market analysis, an excerpt from Markets Insider. It's dated January 7th, 2026, and it tracks the immediate financial fallout, this huge stock rally that happened right after the big consumer electronics show, CES 2026. And it all centers on some pretty blunt comments from NVIDIA's CEO, Jensen Huang.
And so the mission for this deep dive is to really understand the mechanics behind this. Why did this unglamorous memory storage sector go seemingly overnight from a predictable commodity market into the single most critical, most bottlenecked, and now most lucrative part of the AI infrastructure stack? And I think more importantly for you, the listener, what does this new reality actually mean financially, practically, for every single company and consumer who relies on storing data?
Right. Because if the last few years were all about the rise of the machine, the AI chip this dive is about the sudden, almost desperate scramble for the massive, specialized digital brain tissue that machine needs to actually function. We're going to explore how the humble hard drive and the memory stick basically became the new kingmakers. So I want to start by just framing the sheer magnitude of the market's surprise here. Like we said, the storage sector was defined by this sort of predictable boredom. Investors basically just expected capacity to go up and prices to go down forever. That was the deal. And then suddenly, in the space of 48 hours, that entire narrative just completely flips on its head.
It was way more than just sudden interest. It was a violent re-rating of the entire industry's future. For years, this was the sector of, low margins, high capital expenditure risk. Now, the market sees them as the gatekeepers to the whole AI revolution.
And the trigger for this seismic shift wasn't some new product from a storage company. It was a warning from the king of silicon himself. The stock rally just exploded right after NVIDIA CEO, Jensen Huang, flagged data storage as a key constraint for AI. This was him, the head of the company that makes the most valuable chips in the world, admitting that his chips couldn't perform at their full potential. Why? Because they were being choked by slow, insufficient storage.
It's the equivalent of the biggest gold miner in the world suddenly announcing that the only thing stopping them from tripling their output is a lack of shovels. And all of a sudden, the shovel makers become the most important people in the whole operation.
Okay, so to really get the market's reaction, we should probably clarify what these companies actually make, because the rally hit different parts of the market differently. We're really talking about three main technologies that got this massive boost: DRAM, NAND, and HDDs.
Yeah, and that distinction is absolutely crucial. So DRAM, dynamic random access memory, that's the volatile, super fast memory used by the CPU, and really importantly, the GPUs. It's the system's active short-term memory. It's consciousness. Then you have NAND flash memory. That's what's in solid-state drives, or SSDs. It's fast, and it's persistent storage. And then you have HDDs, the hard disk drives, the traditional magnetic spinning disks. They're slower, but they're way cheaper, and they're optimized for just massive, massive volumes. Think archival or cold storage.
Right, now let's look at the evidence, the specific stock performance we saw around January 7th. The numbers really back up this idea that speed and relevance to AI drove the biggest gains. The standout performer was SanDisk. That's the flash memory company that was spun out of Western Digital last year.
SanDisk performances, it's the clearest sign of where investors saw the most immediate pressure point. SanDisk led this whole rally, jumping an unbelievable 28% on Tuesday alone. That is just an explosive and unprecedented move for a large-cap memory manufacturer.
28%. That kind of jump just fundamentally changes the entire story for a company. The source material notes this was SanDisk's strongest single-day performance since February of the previous year. It just shows how rare this kind of thing is for them.
Right. And this wasn't just a one-off event. It was the acceleration of a trend that was already building. The report says SanDisk's stock was already up more than 40% just in the first few days of January. So the market was sensing something was up, but Huang's statement was the undeniable proof. Flash memory NAND is fast. It's directly relevant to high-speed AI data access. So SanDisk becomes the immediate winner in the eyes of investors. They were the top performer in the entire S&P 500 on that day.
But the rally wasn't just limited to the fast flash stuff. We also saw huge boosts for the major hard disk drive makers, which, are seen as even more of a legacy technology. They're just for bulk storage. Western Digital shares jumped about 17% on Tuesday.
And Seagate Technology, the other behemoth in that traditional hard disk space, they were up about 14%. The market gets that even though these are slower, they're still critical for storing the gargantuan data sets needed to train the AIs in the first place. That initial 200 zettabytes of information we're going to get to.
So if we compare that SanDisk's 28% jump versus, say, Seagate's 14%, what does that difference tell us about the market's immediate priorities here?
It signals a hierarchy of urgency. The market is saying the immediate, most critical need is speed. It's the ability for the GPUs to get the data quickly to stay efficient. That's your NAND flash and your DRAM layer. The traditional HDD players, like Seagate, they still benefited because AI needs that massive volume for training data, but the jump was smaller. Because the core bottleneck Huang was talking about, that relates to the active working memory, and that demands flash-like speed.
So the market instantly got it. The problem isn't just storing data, period. It's storing hot data that needs to be accessed, right now by hundreds or thousands of GPUs all at the same time.
Exactly. When you see these huge established industrial players in what was a commodity sector jump 14 to 28% in a single day, it means the market has just re-rated the entire industry. It's not a commodity anymore. It's a critical strategic resource, and it's in a massive shortage. They went from the utility closet to the engine room, basically overnight.
Okay, but someone might argue that, the memory market has always been volatile. We've seen these boom and bust cycles before. Why should we believe that Huang isn't just, say, generating hype here, maybe to favor the supply chain or drive investment in a space he benefits from?
That is a fair and a critical question. The difference here is in the source and the specific language he used. Huang isn't pitching a new product here. He's announcing a limitation on the performance of his own products. His company, NVIDIA, benefits most when AI processing grows without constraints. So if he identifies storage as the choke point, it means the performance ceiling for his GPUs is now defined not by the GPU's power, but by the speed of the data delivery system. That's a self-limiting admission from a market leader, which makes it incredibly credible and, frankly, alarming. It's the transition from storage being cheap overhead to being an existential prerequisite for AI performance.
Okay, let's shift to the core technical reason for all of this, the problem statement itself. For the last, 3 years, the whole story around the AI race has been about compute power. But Huang just decisively shifted that focus to where, as he put it, the vast amounts of data live.
And that transition is absolutely key. We've always separated data into two buckets, right? There's archival, cold, slow, long-term storage, and there's volatile DRAM, fast, for immediate calculations. What Huang is talking about is a new third category, a hybrid that's highly optimized for AI operations. It's that critical link between the massive training data set and the incredibly fast GPU.
And he didn't just say it was a constraint. He used this powerful, very provocative phrase that just instantly crystallized the entire issue for the financial world. He called the memory storage market a completely unserved market today.
That phrase, completely unserved, really needs to be unpacked. It implies something much deeper than just a standard supply shortage. If a market is just underserved, you just scale up the factories you already have. But if it's completely unserved, that suggests the fundamental technology, the architecture required to meet AI's needs, either doesn't exist yet or it only exists in, prototype form at a tiny scale.
Right. And that immediately changes the investment story from just build more hard drive factories to fund entirely new high-speed, high-density architectures that are optimized for this specific AI workflow. We're talking about a necessary paradigm shift in storage engineering.
Yeah, think about it like this. Traditional enterprise storage is like a massive, well-organized library in the basement of a skyscraper. It holds everything. It's cataloged perfectly. But if you need one specific sentence from one book, you have to send someone down, wait for them to find it, check it out, bring it all the way back up to the 80th floor. AI, though, is having a live split-second debate on 1,000 topics at once on that 80th floor. It can't wait for that library retrieval process. It needs all that information instantly available right there next to the processor.
And Huang doubled down on this. He described the future scope of this requirement, saying this new market will likely be the largest storage market in the world, basically holding the working memory of the world's AIs.
That is a direct forecast of a massive shift in enterprise IT spending. If AI becomes the core operating system for all major businesses, managing global logistics, automating creative work, running financial risk models, the memory needed to hold the active knowledge base for these millions of operations will just dwarf the storage needs of everything else combined. It's a brand new, massive category of demand.
So to make this idea of working memory more accessible, we should dive into the specific technical terms Huang used. This is where the real engineering challenge is. He was very precise about what kind of memory AI models are eating up. He said the amounts of context memory, token memory, and KB cache they process are all way too high.
And this is the language of transformer models, of large language models. These terms define 3 specific data access patterns that need extremely low latency and extremely high speed. And that's what traditional spinning disks or even conventional SSDs are struggling to provide at the scale needed.
Okay, so let's break that down. First, context memory. When we interact with an LLM, the context window is everything the AI remembers about the current conversation or the huge document it's analyzing.
Right. Imagine you're a translator and you have to translate a 10-volume historical novel, but you have to keep all 10 volumes in your short-term memory at the same time to make sure it all makes sense.
Yeah.
That 10-volume knowledge base, that's the context memory. The larger and faster that memory is, the smarter and more coherent the AI's output can be. So when Huang says the amount needed is way too high, he means the AIs are being artificially limited by the memory they can physically hold active.
Okay, next up, token memory. Tokens are the basic units of data, right? Parts of words, symbols, things that the AI processes to generate an output.
Exactly. The speed at which an AI can access and handle its token memory directly determines its throughput, its response time. It's like how quickly you can recall words to form a sentence when you're under pressure. When an LLM is generating text, it's making billions of calculations per second based on that token memory. Slow access means slow responses, which means higher costs because your very expensive GPU just sitting there waiting for data instead of calculating.
And finally, the KB cache. This refers to different kinds of extremely high-speed memory buffers that store frequently accessed data or intermediate calculations.
This is a micro-level need. It's all about latency, the time it takes for data to travel from the storage to the processor. We're talking milliseconds, even microseconds. If the system has to wait even a tiny fraction of a second to get a few kilobytes of critical data from the cache, the whole GPU cluster just stalls. AI workloads are way more sensitive to these latency delays than traditional computing tasks, like loading a website.
So to sum this part up, what Huang is telling us is that the future of AI needs a totally new kind of storage. Call it AI-optimized working storage. It has to be incredibly dense to hold the context, incredibly fast to handle the tokens, and have incredibly low latency to use the cache.
And if the existing storage market is completely unserved for that need, well, that explains the astronomical jump in flash and DRAM stock prices.
Yeah.
Investors are betting on the companies that are best positioned to actually engineer and build this new specialized infrastructure. Because whoever solves this problem, they hold the key to the next phase of AI scaling.
The technical challenge is clear, but the financial side is all driven by volume, which brings us to the scale of this data tsunami that's fueling the crisis. We really need to get a handle on the key metric from the source material.
The number is just staggering. Driven largely by AI workloads, the volume of stored global data was expected to top 200 zettabytes in 2025.
200 zettabytes. That unit is so far removed from anything we deal with, megabytes, gigabytes, even terabytes, that it almost loses its meaning. So let's translate that. The source clarifies that 200 zettabytes is the same as 200 billion terabytes.
Yeah, let's try to visualize that. If we use that analogy from before, a standard 10 terabyte hard drive, 200 billion terabytes, means you would need 20 billion of those physical 10 TB drives just to hold the data that's currently being stored.
And let's push that visualization even further to really understand the unserved part of this. A modern enterprise hard drive weighs, about 1.5 pounds conservatively? So if you have 20 billion of those drives, the physical mass would be 30 billion pounds, or 15 million tons of hard drives. That's more than the combined weight of all the steel in the Empire State Building, the Chrysler Building, and One World Trade Center, multiplied by 30.
You're talking about a completely new kind of logistical problem. The physical footprint, the cooling, the power consumption for 20 billion separate devices that all have to be online and accessible. The scale is just unprecedented. And the vast majority of this new data is either AI-related or needs to be AI accessible.
Right. So given that scale, the analysts have reached this consensus that's just shaking the foundations of the memory business, which is demand for data storage is predicted to run ahead of supply.
Yeah.
In what used to be a commodity market, that is basically a declaration of economic war in favor of the producers.
It solidifies that we are now firmly in a seller's market. The capacity of the manufacturers, Samsung, SK Hynix, Western Digital, Seagate to produce DRAM, NAND, and HDDs is structurally just not enough to meet the data creation rate that AI is driving. They gain massive pricing power, literally overnight.
We have some crucial insight here from the International Data Corporation, IDC. They put out some analysis in a December note saying that the memory market is at an unprecedented inflection point.
And that term, inflection point, is so important. It means the curve has fundamentally changed its direction. They said that demand is materially outpacing supply. This isn't some temporary shortage because a factory had a fire. This is a systemic imbalance caused by a new, massive, and permanent user AI entering the market.
And this brings us to the core economic reason why this time is different from all the other supply crunches the memory industry has faced before. The IDC analyst directly challenges the historical context of the industry, which, as they say, has long been characterized by boom and bust cycles.
Right, and that historical cycle is what has kept storage so cheap for decades. When demand boomed, manufacturers would commit billions of dollars, that's the capital expenditure or CapEx, to build new fabrication plants, new fabs. But building a complex memory fab is a massive multi-year project. It typically takes 24 to 36 months before it even starts producing anything.
So the standard model was always demand booms, companies start spending on CapEx, and then 2 or 3 years later, supply floods the market, prices crash, and everyone enters the bust phase until demand catches up again. It's a predictable cycle.
But the analyst states it emphatically. This time is different.
So why does AI break this cycle? In past tech booms, PCs in the 90s, the internet in the 2000s, smartphones in the 2010s, there was always a natural saturation point. Eventually, every person who wanted a phone or a PC got one. Demand leveled off, and the market could absorb the new capacity.
AI demand has no foreseeable saturation point. It's inherently non-cyclical in that traditional sense. First, the models themselves are always getting bigger, so they need more and more training data. And second, the use of those models creates new data that needs storage for context, for cache, and then eventually for feeding back into the training loops to make even better, newer models.
It's a closed-loop system of data creation and consumption that is just constantly accelerating, a virtuous cycle of data generation that doesn't have a natural consumer-based speed limit.
And that translates into a specific economic concept: inelastic demand. If you're Microsoft or Google or Amazon and you have billions invested in NVIDIA GPUs for your AI cloud services, you have to buy the necessary memory, the DRAM and NAND, to run those GPUs efficiently. The cost of delaying your AI deployment or having underutilized GPUs is so much greater than the cost of a 40 or 60% memory price hike. The demand for that memory is inelastic. It doesn't really drop just because the price goes way up.
And that inelastic demand means that even if Western Digital and Samsung build new fabs tomorrow, the rate at which AI consumes capacity both in volume and in that specialized speed will outpace the rate at which they can physically bring new capacity online.
The CapEx hurdle is just massive. Building a new state-of-the-art memory fab costs tens of billions of dollars. Companies are really hesitant to commit to that kind of investment unless they are absolutely certain that demand will stay structurally high for a decade. Huang's statement basically gave them that certainty. But even with that, the time lag guarantees years of supply constraint. The demand curve is just steeper than the manufacturing curve has ever been able to handle.
And that realization that AI provides this permanent, steep, non-cyclical demand floor is what transformed the stock valuations so violently and led IDC to call it an unprecedented inflection point. It's a structural change to the fundamental economics of data storage. Okay, so we've set up the dramatic shift on Wall Street and the economic reasons for the shortage. Now let's pivot to the immediate, tangible consequence for everyone else: the direct cost of memory. This shift signals the end of an era that I think we've all really taken for granted.
We are already seeing just extreme volatility in pricing, especially in the server-grade equipment that forms the backbone of these AI data centers. When NVIDIA's CEO flags a constraint, the supply chain immediately reacts. They leverage their sudden, massive pricing power.
Let's get into the most explosive example, the immediate price pressure on DRAM. That's the dynamic random access memory. This is the crucial, fastest working memory that the GPU clusters need. The Korea Economic Daily reported that two of the giants in this space, Samsung and SK Hynix, are pushing for huge server DRAM price increases.
The proposed increase is, honestly, it's staggering. We're talking 60 to 70% in the first quarter alone compared with the previous quarter. This isn't just inflation. This is a commodity price explosion driven by pure, desperate, inelastic demand from the biggest companies on the planet.
A 60 to 70% increase in 3 months is just crippling for any enterprise that's building out cloud capacity or AI infrastructure. IT budgets and investment strategies all over the world were based on the historical assumption that DRAM prices would be stable or maybe decrease a little over time. This just completely upends those models.
And this is where that concept of inelastic demand really hits home. The major AI players must have that server DRAM right now to use the expensive, power-hungry GPUs they've already bought. If a single NVIDIA H100 GPU costs tens of thousands of dollars, spending an extra 70% on the DRAM it needs is a small price to pay to get that GPU working and generating revenue. They will absorb the hike because the cost of not building out their AI capacity is higher than the cost of the memory itself.
And this pricing pressure isn't just in server DRAM, is it? We're seeing predictions for the wider memory market following the same trend. The market analysis firm Counterpoint predicted that overall memory prices, so covering flash and other components, could rise by 40% through the second quarter of 2026.
That confirms that the AI-driven strain is systemic. It's across the entire memory stack, not just isolated to one niche component. So whether you need the high-speed DRAM for active processing or the high-density NAND flash for persistent data, the whole ecosystem is now being dominated by the price floor set by AI demand.
So what's the core relevance of this price chaos to, the everyday user, or even a business that isn't running a massive data center? The IDC analyst really spelled this out, and I think this is the most important takeaway for the practical impact.
Yeah, the IDC analysts deliver the core message. For consumers and enterprises alike, this signals the end of an era of cheap, abundant memory and storage, at least in the medium term.
That phrase, the end of an era, it just resonates so deeply because for the last 20 years, we've lived under this kind of hidden contract. The cost per gigabyte would always continuously fall. We've operated on the assumption that storage capacity would double and the cost would halve on a predictable schedule, and that allowed us to become incredibly wasteful with data filling our phones, our cloud drives, our backups, with vast amounts of low-value data simply because storage was virtually free.
That whole calculation is now over. For enterprises, a 40 to 70% increase in memory costs means immediate dramatic adjustments to their cloud spending and their data retention policies. Suddenly, keeping years of cold archival data that might only be accessed once every 5 years becomes a major 6- or 7-figure drain on the budget. The whole model of store everything, analyze it later is becoming financially impossible.
The pressure is forcing CIOs to implement data hygiene policies that haven't been necessary in 2 decades. They actually have to decide what data is truly mission critical and what data they can afford to just discard because they can't afford to store everything anymore.
And for the consumer, while the impact is usually a bit delayed, it translates directly into higher prices for everything with memory in it. Laptops, smartphones, game consoles, and especially high-capacity external drives and cloud subscriptions. The idea of getting a multi-terabyte drive for under $50 might rapidly become a thing of the past, at least, until the industry can scale up and design these new AI-optimized memory architectures.
And that phrase, medium term, as IDC puts it, that implies a significant period. We're probably talking the next 2 to 5 years where high prices are just the norm. The massive investment needed to build those new fabs and develop the specialized storage that Huang is demanding just takes that long to come online. And during that lag, high prices will be the natural market response, forcing behavioral and financial changes across the entire digital economy.
This whole transformation confirms that the AI boom isn't just a software thing. It's so powerful, so resource-hungry, that it's actively restructuring the foundational economics and the physical infrastructure of data itself. Storage isn't just a boring cost center anymore. It's the bottleneck preventing global AI deployment at the speed and scale we've all been promised.
So let's synthesize this massive shift we've just explored. The critical link here is that the rise of AI's insatiable and very specialized demand for active working memory, for context, for tokens, for cache, It exposed storage as the immediate next major bottleneck after computing power.
And that exposed constraint triggered a massive immediate financial shift, proving the market believed Huang instantly. We saw these shockwaves in the stock market, SanDisk's jumping 28%, and immediate price volatility in the actual components, with server DRAM prices jumping 60 to 70%. The market is acknowledging that storage is now the limiting factor on AI's growth.
We are firmly in what IDC called an unprecedented inflection point. The economic reality is changing because the 200 billion terabytes being generated are demanding specialized high-speed access that the current supply models just can't meet. The era of cheap, abundant memory is, for all intents and purposes, over for the next several years.
And if we take that IDC statement that this time is different really seriously, it implies that AI demand is permanently redefining the baseline for storage needs. We're not just waiting for some temporary demand to fall off. We are waiting for global supply and architecture to fundamentally restructure itself to accommodate a new, massive, permanent consumer.
Which leads us to our final provocative thought for you, the listener. If this massive AI demand permanently redefines the baseline for storage costs, what existing industries or services that rely on the assumption of cheap, abundant memory will be forced to dramatically restructure their business models because their storage costs just doubled or tripled?
You can consider a couple of specific examples. Think about the massive streaming libraries, the ones that hold petabytes of older, rarely watched shows and movies that are just kept online just in case. Their entire business model relies on the low cost of magnetic cold storage. If the cost of storing that archival data skyrockets, they have to fundamentally change how they operate. Well, they start deleting less popular content.
Or what about financial institutions? They are legally required to store decades of transaction logs and historical market data, also mostly on cheap magnetic storage. A sudden structural cost increase there could lead to huge budget pressures, forcing them to reconsider how much data they keep for how long, or maybe even accelerate their move to new, more efficient but very expensive specialized storage platforms.
And once this storage constraint is eventually addressed, and billions are being poured into solving it right now, where does the next unserved market bottleneck emerge? Will it be cooling capacity, given the density that's needed? Will it be the physical space in the data center to house, 15 million tons of metal? Or will it be the sheer raw power delivery needed to keep all that fast storage online? The bottleneck is always moving, but for right now, the action is firmly focused on the memory aisle.
This deep dive really shows that even the most overlooked, unglamorous pieces of technology, the plumbing of the digital world, can suddenly become the single most vital component dictating the future of the entire tech ecosystem. It's a good reminder that the plumbing is just as important as the engine, maybe even more so.
Absolutely. Thank you for joining us for this deep dive into the surprising world of storage market dynamics.